Oil shipments are plummeting in the Strait of Hormuz. This critical choke point is seeing flows drop to pre-peace deal levels, directly impacting global supply and sparking serious market fear. This isn't just about gas prices at the pump. It's a massive systemic shock hitting businesses right now. According to a recent report by Bloomberg, oil exports from the Gulf have fallen by 20% in the past month, with tanker tracking data showing a significant decline in vessels passing through the strait. The Strait of Hormuz is responsible for approximately 20% of the world's seaborne oil trade, with around 21 million barrels of oil passing through it every day. This decline is particularly concerning as it's happening at a time when global demand is already under pressure due to the ongoing pandemic and economic uncertainty. Here's the deal. The Strait of Hormuz, that narrow strip of water connecting the Persian Gulf to the open ocean, is a huge deal for global energy. Yahoo Finance Canada just highlighted how shipments are falling back to levels we haven't seen since before the recent peace deals. Think about that. We're erasing years of stability. This isn't some distant conflict. It's a direct threat to the flow of crude that powers everything from manufacturing to transportation. Every business relying on stable energy costs needs to pay attention. According to the latest data, oil shipments through the Strait of Hormuz have dropped by 15% since the start of the year, with some estimates suggesting that this decline could continue unabated if tensions escalate further. What's driving this? War reignited. When geopolitical tensions escalate in such a vital region, it doesn't just make headlines. It creates immediate, tangible risks for the global economy. This isn't speculation. It's a documented trend. Reduced oil flow means tighter supply, and tighter supply means higher prices. For businesses, this translates to increased operational costs, squeezed margins, and a potential ripple effect across every industry that uses or transports goods. We saw this play out during past conflicts, and the playbook is depressingly familiar. The Strait of Hormuz, being the world's most critical choke point for oil shipments, has seen a significant decline in the number of tankers passing through. Here's what nobody mentions. While consumers fret about gas prices, savvy traders and energy companies are already cashing in. Futures markets are volatile, but for those with capital, strategic hedges, and foresight, this uncertainty is an opportunity. Logistics companies with diversified routes or premium service options are also seeing demand surge as businesses seek to de-risk their supply chains. The smart money isn't just watching, they're moving, looking for ways to profit from the volatility rather than be crushed by it. It's a ruthless game, but it's happening. According to a report by Bloomberg, oil prices are expected to rise by 20% in the next quarter, driven by the reduced oil shipments through the Strait of Hormuz, with West Texas Intermediate crude oil futures trading at over $100 per barrel. Top analysts are sounding the alarm. They're not just worried about crude prices. The real fear is how quickly global supply chains could unravel. Bloomberg economists suggest that even minor shipping delays through critical routes could trigger domino effects, impacting everything from electronics to everyday groceries. What hits you harder than a gas pump? The cost of getting those goods to market. This isn't just about big oil. It's about the small business owner waiting on parts from overseas, facing unexpected tariff hikes or shipping bottlenecks. Smart money is already looking at localized sourcing and nearshoring strategies. According to a recent report, the Strait of Hormuz, a critical waterway for oil shipments, has seen a 25% decline in oil tanker traffic in the past month, bringing volumes to levels not seen since the Iran-US. Nations are scrambling, not just for oil, but for stability. We're seeing talks of emergency reserves being tapped in key economies, while others are fast-tracking investments in renewable energy infrastructure. The ripple effect is clear. Shipping giants are rerouting vessels, adding days and huge costs to transit times. Meanwhile, a curious signal emerged yesterday. Gold prices dipped on July 16th. While typically a safe haven in times of unrest, this drop suggests a deeper market liquidity crunch, where even secure assets are being sold off for cash. It's a counterintuitive move that speaks to widespread market apprehension. According to the International Maritime Organization, Oil shipments through the Strait of Hormuz have declined by over 20% since the conflict escalated, with some estimates suggesting a drop of up to 40% in the sea. Cast your mind back to previous energy disruptions. We've seen moments when trade routes became flashpoints, forcing industries to pivot or perish. Those who thrived weren't the ones frozen in fear. They were the entrepreneurs who adapted fast. Think about the tech boom accelerated by remote work, or how niche logistics companies exploded during the pandemic. The pattern is consistent. Major disruptions don't just create problems, they reveal latent demands and force innovation. History shows the businesses that pivot to solve new immediate pain points are the ones that come out stronger. For instance, in 2019, the Strait of Hormuz saw a 10% decrease in oil shipments due to heightened tensions between Iran and the United States, resulting in a loss of approximately 1.5 million barrels per day. Who's truly profiting from this panic? Not just the big energy players, but the companies building hyper-efficient logistics software that can predict and reroute shipments. Think SaaS platforms optimizing inventory for manufacturers, or even local delivery services that can bypass national distribution failures. On the flip side, small-scale import-export businesses without robust contingency plans are taking a beating. Their margins are razor-thin, and sudden cost increases or delays could mean lights out. The winners are building resilience. The losers are relying on old, fragile systems. According to a recent report, the global logistics market is expected to reach $1.5 trillion by 2025, with a significant portion of that growth attributed to companies able to adapt to changing circumstances.